Continuing with our theme of political and regulatory insight, we're now joined by Toby Fiennes, Head of Financial System Policy and Analysis, Reserve Bank of New Zealand. Toby has been part of a number of FSC Connect webinars throughout the year, and we thank him and the RBNZ team for their continued engagement with the industry. It has been greatly welcomed among the FSC community. In this session, we'll hear about the Reserve Bank's priorities for the near and long term, followed by a Q&A session with Heather du Plessis-Allen. The Reserve Bank clearly has a big job in working out the best way to support the economy through the pandemic. The measures taken so far, including a bond buying program and lower OCR, have been effective in lowering interest rates, meaning more cash for spending and cheaper money for businesses and households to borrow. The RBNZ is now looking at additional measures to lower the cost of borrowing and ensure banks have enough cheap liquidity to back investment by businesses and spending by households. Options on the table include funding for lending, which could be ready to go from November, and negative interest rates. Further monetary stimulus and cheaper rates is likely, of course, to fuel house and other asset prices, and the bank's response to the pandemic has been described as a least regrets approach, with its chief economist stating, "We would rather be in the situation where we have done too much too soon rather than too little too late." So does that mean the OCR will move into negative territory before too much longer? Welcome, Toby, via Zoom.
Thank you very much, Vanya. Tēnā koutou katoa. It's great to have this opportunity to tell the Reserve Bank's story today. What I'll do is I'll briefly talk about our overall response to the COVID-19 crisis. I'll then touch on the outlook for monetary policy, the work we've been doing on bank stress testing, and of particular interest to this audience, I want to talk about our two insurance reviews, so that's of the legislation and of the solvency standards. So overall, the economic shock from COVID-19 has been massive, at least once in a generation, if not several generations. And while the pandemic does seem to have been brought under control here for now, and the economy is showing signs of recovery, with the whole country now back at level 1, the full effects of the economic downturn are yet to be seen. And I think this slide tells the story well. So a very sharp decline in GDP, with our most recent projection, which is August's, actually showing a slight improvement over May's. But overall conditions are likely to remain weak for a prolonged period for three main reasons. First of all, there is considerable uncertainty about the global outlook on which we're dependent. Support packages will at some point start coming to an end. And there's also the knock-on effects of the serious income losses in the most affected sectors in the economy, such as tourism. And that's what the chart shows, the economy not returning to 2019 levels until about 2022. So the next slide, I'm having trouble here, excuse me, shows unemployment peaking at around 8% and only very slowly returning to even post-GFC levels. Now, happily, the banking system entered the crisis in pretty decent shape, having built up its financial strength over the previous decade of favourable conditions. The crisis hit us very hard and very fast, and that did demonstrate how important it is for banks to be prepared for the unexpected. Now, banks have the buffers in place to now continue supporting their customers and the broader economy through the recovery phase. So this slide shows the support that was given to mortgage customers, and it's informative. So a full 18% of mortgages have been provided temporary relief, either by way of interest relief or full deferral. And it's been very important that banks have been both willing and able to do so. So just more generally, for the Reserve Bank as a whole, it required a truly whole-of-bank response. We're a full-service central bank, and we saw the benefits of being that, and being small and being nimble. We were able to coordinate information and coordinate decisions. Our aim throughout has been to support cash flow and confidence. We acted on many fronts, so monetary policy, regulatory, markets, and cash. That's cash in your pocket currency. So on the monetary policy side, we reduced the OCR to a record low of 0.25% and began a large-scale asset purchase program, LSAP, of buying up to $100 billion of government bonds. These actions have been successful, and I'll come back to it. In Prudential Supervision, which is one of the areas I'm responsible for, we eased a number of our regulatory requirements. We put a hold on policy work we had underway to give industry space to support their customers, and we also restricted dividend payments. So specifically on the regulatory side, first of all, we enabled banks' mortgage deferral schemes. So that's what's up on the charts at the moment. So to do that, we issued guidance about our capital rules, make it easy for them to extend this support. We also removed our loan-to-value restrictions. We reduced the bank's core funding ratio minimums. We also postponed planned increases to banks' capital requirements after our review of these last year. So this set of prudential responses aimed to do two things. So first of all, to help institutions offer that much needed support to their customers. And secondly, to preserve their financial strength, so hence the dividend restrictions. So the public could continue to have confidence in their bank's insurers, and the bank's insurers could continue to be confident enough to support their customers. So acting on both fronts. On the financial markets side, we established a range of facilities for market participants in order to support market liquidity and to make sure that our OCRs could be passed through. And then finally, on a rather more practical note, our currency team worked alongside the industry to ensure that the public's strong demand for cash during lockdown period was met. So although transactions were quite low, in fact, the public demanded about 10% more cash than normal during that lockdown period. So just moving back to monetary policy. So in September, the Monetary Policy Committee confirmed its commitment to the current level of the OCR, the size of the LSAP programme, and it discussed progress made on additional monetary tools. So this slide summarises our past and present strategy. So first, our OCR cuts and LSAP actions have worked through the four expected channels. So that's cash flow, new credit provision, the wealth effect, and the exchange rate. And as you can see from the table at the bottom right, fixed and floating mortgages and bond and swap rates have all fallen by between 75 and 120 basis points since early 2020. So our actions are working to depress interest rates. And we are preparing additional monetary policy tools. So notably, the Funding for Lending Programme, which I'll call FLP, Funding for Lending Programme. So this programme will provide long-term secured lending direct to banks at a rate close to the OCR, and they will be expected to lend it out to the economy. So an FLP reduces banks' reliance on other sources of funding, leading to further declines in lending rates and thus more stimulus for the economy. And this slide explains the mechanism by which it works. So you've got a depressed funding pricing for the FLP, which flows through to the prices that banks need to give for other forms of funding. So we expect an FLP will be available before the end of the year, and the Monetary Policy Committee has agreed this could be deployed ahead of other tools, such as the negative OCR. And overall, the MPC knows that it'll need to provide additional significant economic support and prepared to do that for a long time. So I just want to move on to something else, which is stress testing the banking system, a key tool we've used. So stress tests, we use models to see how hypothetical scenarios would affect the financial strength of banks and their ability to continue supporting the economy. And not a forecast of what will happen, but a relatively pessimistic look at what might happen so that we can test their resilience. Now, our base case stress test scenario assumed that the unemployment rate rises to 13% and a 1/3 fall in house prices, which is now actually well beyond what we expect. In our more severe scenario, unemployment rose to 18% and house prices fell by a half. But the overall conclusion of the stress tests is that banks can draw on their existing capital buffers and continue lending to support lending in the economy during a downturn of the severity of the baseline scenario. So they keep well above that 6% minimum. So it reinforces our view banks have the capacity to continue supporting their customers as they have so far. In the more severe scenario, banks' capital fell below the regulation minimums, and they need to take significant mitigating actions to continue lending. So they aren't invulnerable, and this reinforces the need for strong capital buffers to provide resilience against severe but unlikely events. So lastly, I just want to mention our insurance policy work. We recently restarted a review of our insurance legislation known as IPSA, Insurers Prudential Supervision Act. We had put this work on hold for a number of reasons, including the pandemic. It actually became law in September 2010 and has been tested. So the first Canterbury earthquake happened just 3 days after the law was passed and resulted in, as you know, an intense period of supervisory activity, other activity over a long period, including the government rescue of AMI. So what are we looking to achieve with the review? So first, assess the performance of IPSA, how it's done, how well and how cost effectively it's achieving its purposes, a supervisory regime that promotes a sound and efficient insurance sector. We also want to assess the consistency of the regime with international guidance and with other legislation. And then ask ourselves the question whether we should align, for example, the insurance to banking regimes more. So in the first phase, over the next 12 months, we'll consult on the broad scope of the legislation. Does it capture the right organisations and products? How to define insurance? How do you treat overseas insurers, statutory funds and so on? And throughout that, we'll talk intensively with wider government, industry organisations, professional organisations. An initial substantive consultation paper will be out in November about those questions. And alongside it, we're also going to do a review of the solvency standards, so that's capital for insurers. A number of drivers for this. So upcoming changes to accounting standards mean we need to make some changes. The IMF had a number of good recommendations for us in their review of the financial system in 2016. We also had the review by Trowbridge and Sholtons of our performance under the regime in how we managed CBL, insurance company that failed a couple of years ago. We also completed a review of the appointed actuaries regime. So a paper setting out the timeline, principles and process for this review was recently published on our website. We're very keen to get people's feedback on that from as wide a population as possible, and a more substantive consultation paper will be released in November. So on that note, thank you very much for listening. I'm now happy to take questions on any aspects that you would like to talk about.
Toby, thank you so much. It's wonderful. Thank you for your insight. Just a reminder, if you are watching, you are welcome to send your questions, and we're already getting quite a few good ones, so we will be putting them to Toby very, very shortly. Can I just start, Toby, with the fact that as a result of the Reserve Bank's actions, we have seen quite a spike, a jump up in asset prices. Are you worried about that?
Yeah, I mean, I think we don't target any particular level of asset prices or house prices. I mean, certainly in the short term, our
I think we might have lost Toby.
Prospects for New Zealanders. Sorry, can you see me? Okay. I mean, clearly, there's long-term considerations. We have for a while been concerned about, the possibility of sharp corrections in house prices. So over the longer period, if we see house prices getting up to what we consider to be unsustainable levels, then yes, we'll certainly be looking. Probably one of the worst things that could happen during a severe downturn like this is a spiral of sharp declines in house prices that create fire sales. People lose confidence and so on. So we are keen to protect. We are keen for that not to happen and protect.
Are you concerned about a negative OCR? Are you trying to avoid one?
No, we're not trying to avoid one. I mean, there are other countries that have tried negative OCRs. We have said that we are open to the idea of negative OCRs. We said that the current 0.25% is on hold until early next year. No, I mean, if you look at the current term deposit rates, for example, they're over 1%. With an OCR of 0.25%, we could drive those down lower with a negative OCR.
Toby, a question here from the audience. How ready are bank computer systems to cope with those negative interest rates should they arise, and how much time do they need to get their systems working?
Yeah, so we went out earlier this year to make sure to check with banks in detail that they would be ready for a negative OCR if we decided to implement one. We got those results in. Obviously can't share individual bank results with you, but we're just collating those now, and we should be able to let people know where that stands at the time of our financial stability report, which is late November.
All right. You have said that banks now have buffers in place, but it sounds like this was largely due to the RBNZ not bringing in extra regulation. Now, if the buffers have worked, why is extra regulation needed, and what can be learnt about this for the insurance sector?
Okay, so two questions there. So just on the bank buffer side, I mean, I think we are in a position of actually wishing that we had brought in those higher buffers some years ago. Buffers are considerably better than they were at the time of the global financial crisis. So banks are much better capitalised than they were then, and that's what has enabled them to be confident to lend. So it's not just about whether banks can survive a big shock like this, but it's whether they can continue to provide credit at a steady rate during this downturn. And the less severe stress test scenario showed that they could do that. We would still be worried about that much more severe stress test, where it looks like the banks would not be able to continue to provide that credit, albeit it's a pretty unlikely event now.
Are you satisfied, Toby?
Sorry, Karen. Yeah.
Are you satisfied with the level of stimulus that you're getting from the government to help you guys out?
Look, I think the government's books were in a good shape to support the economy going into this pandemic. I think that the ability of the government to operationalise the wage subsidy scheme, for example, to provide the support that was needed, has been of help to the economy. Yes. By the way, Heather, you also asked me about the insurance sector. So we're in the early days of that solvency standards review, which is capital for insurers, as I said. We don't have any priors about it. The considerations are a little bit different to what they are for banks, but we do start with a presumption that we want a sound and robust insurance sector, and the 1 in 200 year stress is kind of the mark that most countries try to hit with their capital requirements for insurers.
Toby, thank you for that. Can I just take you back to the level of stimulus provided by the government? What else would you like to see from them?
Look, I don't think there's anything particular we've got in mind there. We're an independent central bank. We respond to what the government does rather than try to direct what the government does.
Okay, there has been a fair bit of chatter today already about the compliance, the regulations that have already been put on business by especially the Labor government. You obviously have led the charge by easing your own regulatory requirements. Would you like to see a similar approach from the government?
I mean, I think that's up to the government, really. I think there are some regulations that, I mean, just referring back to our regulations, there are I mean, there are some that are there specifically to be removed during bad times, so that people have more room to breathe and to undertake activity than they would do during the business as usual time. So, for example, the loan to value restrictions. I mean, I would like to comment on regulations outside our area. No. Thanks.
What do you see as our biggest obstacle to recovery?
Quite a few. I mean, first of all, I think there's confidence is one. I mean, confidence both that there will be continued commitment to supporting the recovery, confidence that the financial system here is sound, and confidence, which I have to say at the moment is probably lacking, that the global economy is going to have a strong recovery. So that's probably the first thing. I mean, I think probably overlaying all of that is uncertainty about the health situation, both globally and potentially locally. So that's both the virus itself and also the responses. So there's that we've obviously still got border closures. There's the potential for going back into further types of lockdown if we have another wave. So I think those are those are pretty significant obstacles, and I mean our role here is to provide all the support we can to make sure that banks, insurance companies take long-term through the cycle views and continue to support their customers that have good long-term businesses.
Toby, I've got more than one member of the audience wanting me to ask you this question, so here you go. Messaging earlier this year from the RBNZ showed the insurance sector in a pretty bad light. How did this negative messaging help promote consumer trust in the sector?
Okay. I mean, I take issue with the messaging about a pretty negative light. I suspect what is being referred to there, and this was pre-pandemic, was the analysis we did about the solvency, that's the capital levels of insurers, which did show that there are some insurers, and particularly if you make international comparisons, there is a subset of insurers, not all of them, but a subset of insurers that are running relatively close to the sort of minimum lowish levels of capital. And I think we were calling out the fact that that those insurers should think about ways of bolstering their capital positions so that they were unambiguously secure and could demonstrate that they were resilient enough to meet pretty severe shocks. I mean, I think actually we've had a number of meetings in this forum with the FSC and their members, which has been really constructive, and we are supportive of the FSC. We want to work hand in hand with the industry through these times.
All right, Toby, thank you so much. I really appreciate it. Thanks for your candid answer. And we will hand it now back to Vanya.
Thank you, Toby, for giving those great insights into the outlook for the Reserve Bank and updates on New Zealand's economic prognosis for our viewers.